And this time coming, we will not have a coffee break, so we'll have 3 speakers, one after the other. And we'll try to allow the questions and answers after the presentations. I'm trying to add lib here so I can have the laptop reboot as I have shut it down by mistake. So in the meantime, I would like to say thank you for staying. I don't know how many people have lost. I have only 2 people apologize for not being able to stay for the afternoon session. One colleague of ours from Syria that had to leave, and one person from Abu Dhabi that he has a flight to catch. And we have an addition of somebody that was not around in the morning that joined us this afternoon. Happy also that we have some people from the media still with us, and hopefully they will have a chance to write more about projects. The lovely lady in the picture, that's my daughter. I'm looking for a husband.
And
anybody that would like to know the requirements, talk to me after the conference.
Capital required.
In the morning when I did make a small introduction about the foundation, I forgot to mention something very interesting. Since January, the foundation website is being visited a little bit under 1,000 times a day. We ourselves at the Mohanna Foundation, we are very surprised. So we have went into analyzing who are visiting our website, so to see the geographical spread. And we also analyze which documentation, which pages of the website are being visited. We noticed that the reason of the big jump of this year's visitation of the website is our implementation of two new elements of the Mohanna website. One of them is a soft library. We have a very extensive library which is free of charge. Anybody can download any document from the library. We have about 1,000 books on it. Or articles or documents, whether it's on merger and acquisition, whether on corporate governance, whether it's on insurance accounting, whether it's on reinsurance or asset liability management. So please do feel free to visit the Mohanna website. Another thing which is very interesting, we implemented a discussion group, interactive center, where you can go and put a question in, and if we don't know the answer, maybe somebody else on that visit the website can reply to you directly. So that's a new service that we provide to the user of the Mohanna Foundation website. And I think we are ready now. I would like to thank Paul to join us on this session because I think he was the person that we gave him the least time to prepare. Everybody had a good head start. Paul, I'd like to thank him for accepting to speak with us with a short period notice, and I'm sure everybody will look forward to it. That's yours.
Good afternoon. Thank you very much, Wayne, for inviting us.
my presentation today is about mergers and acquisitions due diligence in a new era of corporate governance. Now, the terms that are in the title of this presentation are often heard in the media, and we hear all the time people about debating what corporate governance is, what due diligence is, and I challenged a couple of people during the last 10 days to define due diligence in English, and the answers were not very promising. So I'm going to start with that. First of all, I'm going to quote for the farewell speech of President Ronald Reagan. He said, you're going to read more about it in a second. My view is that President Gorbachev is different, so that there's a new way to deal with the Russians. But this is not what I want to talk about. What I want to talk about is what he said before and after. Please focus on a couple of sentences. We must keep up our guard, but we must also continue to work together to lessen and eliminate tension and mistrust. This summarizes quite well what due diligence is about. You have a process, you're working with the people for the rapprochement, but at the same time, you have to make sure that what they're promising, what they're representing, warranting, as lawyers would say, is correct. And then the second sentence, what it all boils down to is this: I want the new closeness to continue. So it's a process, the due diligence process itself is not a process whereby we're trying to destroy the deal. We're trying to strengthen the deal to make sure that it happens, to make sure that everything that was promised is there. Okay, we protect each party, but we don't want to destroy it. The new closeness has to continue. And in a typical American way, it's still trust but verify. It's still play but cut the cards. It's still watch closely. So, again, we see this tension between wanting to work together and wanting to check everything. And this tension is going to be one of the recurring themes of this presentation. Lastly, and this is slightly more on the negative side, don't be afraid to see what you see. We want the due diligence to succeed. We want the deal to go through. We want to create value for all shareholders. But there are cases where the people conducting the due diligence will see things that they don't like. At that point, the temptation to carry on with the deal is quite strong. But don't be afraid to see that if this deal is not to go through, then it might as well fail. And I'm saying that, and everybody knows that investment bankers make the bulk of their money from success fees. So we have to make sure that if you see something emerging that you should not let happen, then don't be afraid to do the right thing. In plain English now, due means necessary. And diligence does not mean verification. It means assiduity. It means effort, dedication. So this is the still play but cut the card part. A certain project or endeavor has been agreed upon. So people in principle have agreed that they want to work together. In order to agree, they've promised each other things. They've said we have so many deposits if it's banks, we have so many written premiums if it's insurers, we have a plant that can do so many different, that number of tons per year. They've promised each other things, but they have not verified these things. And to be honest, in Lebanon and elsewhere, it might be the case that people don't really know what they have. So this chart looks a little bit like Chris's chart, the one that you've seen before, but I focus more on a slightly higher level, so I did not go that much into the details. First, we start with the concept. Somebody thinks about the deal, about the possibility of a deal. It might be the companies themselves. It might be one of the company looking for a suitor. It might be the investment banker, a broker, a lawyer, somebody who has access to the information. Somebody thinks about the deal. An approach is made. The parties establish contact and start talking. At that point, the possibility of a deal emerges. The talks develop, and quite very quickly we will find out what needs to be done in order to make that deal succeed. Then they reach an agreement. But that is, well, either the letter of intent level or the memorandum of understanding level. It's an agreement that's not quite solidified yet, so we will need to work more in order to make it happen. But provided the information that was given by the parties, that were exchanged by the parties, are correct, this deal can go. This is when due diligence starts. Everybody agrees that due diligence starts towards the end of the process. I will argue throughout this presentation that due diligence is actually not a specific step that happens towards the end of the process. It is a step that builds into the process. My argument is that, as you see this arrow, there are iterations that will take place to, I would say, information coming out of the due diligence process will iterate the talks and iterate the discussions. For example, a plant might not be able to produce so many tons per year. Sometimes the people who have the plant don't know it. And I'm not only talking about Lebanon or third world countries. It can happen anywhere. So these iterations will take place. Sometimes some of the way, a specific way to look at a specific number is not the one that the other party wants. So you will need time to redefine, to shape the data in order to allow the other party to understand what's being talked about. So in practice, the due diligence occasion iteration of the talk. And there's a different way maybe to draw this value chain, which is to say that due diligence starts with the approach and finishes with the transaction, but it's an overarching step. Okay, due diligence of service companies are more difficult, particularly financial ones, because most of the assets are intangible. There is no plant or equipment. When I visit a manufacturing plant, I just go around the plant. I can see the production taking place. I can see some of the monitors giving information. I can see some of the total quality measures that are visible on all screens. Here, there's nothing. The closest thing they have to a plant in a huge services company, I mean banks, I mean consulting firms, and I mean insurance companies, of course, I mean this class of business. The closest thing they have, sometimes when there are operations, is their IT system. So you start with the IT system. Walking around the IT system is not as easy as walking around the plant. This is one of the key processes that need to be tackled early on, otherwise mergers can fail, or mergers can delay the production of value for the two companies, or for the merged companies. I can give an example. One of the large $1 trillion Japanese bank had problems that stopped hundreds of ATMs, or cross access on the accounts did not work with the other bank. So if you had an account with bank A and you went to bank B, post-integration you could not see your account. So even in $1 trillion companies, IT is key, and IT generates trust. Financial items are intangible. Now I'm not going to go, I cannot anyway, I'm not going to go into the technical part of this, but technical provisions need to be very well analyzed. You need to make sure that everything is fully accounted for, that come the time when something has to be paid, the company has the resources to do so, but that's only part of it. There's a complete matrix of parameters that need to be checked. The human resources. I'm not going to dwell too much on that because I'm going to get back to that at a later point. Assets take the elevator out every night. I think it was Warburg who used to say that before they were purchased by SEC. Regulatory compliance. Again, I'm going to talk a bit more about that under governance, but it's very important to understand that regulatory compliance is this, at the same time, a soft and a hard issue. You have the British system where regulatory compliance is more a nod and a wink, as they say there. And you have other systems like the American one, where you have a specific set of rules that you need to follow. In both cases, the principles have to be there. It's not enough to say that I comply with all the regulations, because Enron complied with all the regulations, for example. For all these reasons, it's generally accepted and uncontroversial that due diligence of financial companies is more complicated. Okay, now a static view of an insurance company could look something like that. Of course, I could go through that in more detail, but this is not the purpose of it. This is the income statement of an insurance company broken down into its constituent parts. The interrelationships between the different items can be analyzed. For example, we can look at technical provisions compared to premiums. We can look at OPEX compared to premiums and get cost to income indications. We can look at the part of net income that is generated by financial returns. There's a whole string of different things, and some people around here have seen the full presentation around that. But suffice it to say that you need to look at least a static view of the work. And some of these items will need to be further iterated, possibly with specialists. The second stop is the balance sheet. Now the balance sheet, these are the main items in the balance sheet. Banks, sundry creditors, technical provisions, etc. Also, we will look very quickly during the due diligence at some static indicators. For example, the adequacy of cash and investments relative to technical provisions. At the end of the day, technical provisions are an indication of what this company is likely to pay at some point in the future. So does it have the resources for that? How well or how much is it using reinsurance? Believe it or not, this simple ratio tells you quite a lot about insurance companies. Many insurance companies in the market behave like pure brokers. And some insurance companies have started thinking about real insurance risk. The balance sheet, fixed assets to total balance sheet. That will give you the real estate exposure, for example. To name but this, but there are others. The liquidity, or an indication of liquidity. Cash and investment over total balance sheet. For example. Shareholder equity. Now, this is really very rough. Basel will give you much, much more. International accounting standards will give you much more. And all the other professional indicators will give you much more. But this is a simple indication that is still valid in level because unfortunately there are companies that are on the edge. Now, it's not enough to look at the income statement alone or the balance sheet alone. We need to understand how they interreact with each other. Do we have the right balance sheet for the amount of premiums we're writing? Do we have the right investment return for the cash and other assets that we have? Do we have the right rent return if you have real estate, for example? A lot of things need to be analyzed thoroughly. The interrelationships between the income statement and the balance sheet, A, are a step towards building a cash flow statement, which is a necessary phase in the valuation of the company, and also are one indicator to as to the riskiness of the company. Here's how, at a very high level, you can build a free cash flow model for insurance companies. And I mean a very high level. This does not dissociate between different business lines. It does not look at products specifically, but it does give you an indication. And using some rough measures like the combined ratio before or after reinsurance will get you quite far, because some companies are really good at selecting risks, and others are not, but use reinsurance better. Strategic due diligence is, we start looking now at the softer side of the due diligence. Marketing, a lot of this was mentioned earlier today. Complementarities in for synergy, the regional mix of clients, in the product mix, in the pricing, in the image. I think that branding was mentioned this morning. Information systems, I cannot stress the importance of IT enough. Without IT, there is no pure service company in the 21st century. Be it for risk calculations, be it for reporting, be it for regulatory compliance. If you have to spend 25% of your time as a CEO looking at the numbers, then something is definitely wrong. At building the numbers. Human resources, it's important to have a cultural fit. There are many statistics about mergers and acquisitions. One of them is that most mergers fail, and the other is that most of the failures are due to human cultural differences. I don't know if it's correct, but we've seen it often cases. I'll get back to the human resources. Back office and claims handling. We touch the client, we contact the client when he buys insurance, and we contact the client when there's a claim. We contact the client when he needs to be informed about something, when we sell, when we promote a new product or new service. One of the unfortunate contact takes place when there is a claim. And you know the statistic that says that an unhappy client tells 11 persons, whereas a happy one tells 1.2. So the due diligence has to make sure that at the strategic level, the two entities or more are have a fit. The human dimension. I would say that it will simply fail. The rapprochement will simply fail if the human dimension is not correctly accounted for from the beginning. And there are parts of this human dimension that are mechanical. This is why this chart, you'll see the second, was built that way. And parts that are not mechanical, that are on the softer side. But the mechanical part are here. First, who does what? Often in the press release after a merger, or just before the merger takes place, we'll hear company A is to purchase company B, CEO of company A will be chairman, CEO of company B will be CEO of the combined entity, that will be on the board, etc. You need to make sure that these things are handled very quickly, at least at the very, very top level. And then you work your way down. Are the top people culturally and personally close? I cannot say that every merger where people that were not culturally close failed, but it makes things more difficult if people don't like each other. Our corporate culture is generally close. The top people have to like each other, but the two cultures have to fit. If you have an elitist kind of institution, let's say East Coast, United States, and people coming from the Midwest, it might not work. And it has failed in the past. Process management, who will drive which part? Here, in the process management, it's important because the decision to merge is only the beginning. And it puts in action a series of workshops that need to be tackled one by one and with a special care given to details. Redundancies. Now this is maybe the least agreeable part of the merger, but it has to be done, often cases. It's important to manage this process in a very, very transparent way. The more you communicate, the better it is. That's the internal communication part. And that's the external communication part because clients need to be reassured that this is going to happen the right way. Now, I haven't spoken yet about the investment banker. The investment banker starts the process sometimes from the beginning or accompanies the process right until the early phases of implementation. I don't think investment banking is about conducting the implementation phase itself, but I think that the investment banker should help craft the contracts, help craft the structure, and stay around while the initial phases are being executed. While this is happening, and as I said, due diligence can take longer than just one specific phase. It can be a whole process that accompanies an entire value chain. It's important that the investment banker look and is not afraid to see what he sees. So some good deals can break down and fail because the people at the top did not get along. And some bad deals can succeed or go through and fail later if the people at the top get along. It's important to be able to dissociate between the two types of deals and to make sure that if a deal is not worthy, then it should be let fail. If it's worthy, then it should be salvaged. I would not say at all costs, but at a certain cost. There's no easy framework to do that. As I said, accompanying the deals to the first phases of implementation, I think the colors are okay. In the pre-merger, it's definitely investment banking, potentially with other professional services firm. In the post-merger, it's definitely other professional services firm. I meant management consultants, I meant specific consultants for certain cases. In the middle, while the handover is happening between the investment banker and the others, my view and that of SARDAR Investment House in general is that we should stay around. Because we know why certain clauses were written that way. We know why certain measures were taken that way. We were there when things were negotiated. So we might as well make sure that the early phases of implementation, we have some level of oversight. Now, governance. Governance is defined in the dictionary as being the manner of governing. It appears to be a very new concept. I think starting in the early 90s, people started writing PhD theses about it. It's not a new concept. Governance is when there are more than a few people doing something. It can be a political system, it can be a corporation, it can be anything. So in the Middle Ages, for example, there were only apprenticeships because all people were just doing manual work. The moment the Industrial Revolution occurred, there was a need to build larger corporations, and governance started at that point in business. Governance is in all systems. If you have a political system, it needs governance. Whatever you have, you need governance. Julius Caesar was writing a civil code 2,000 years ago. So governance is not at all a new concept. The terminology of governance is new. People are using the new terminology, thinking about the issues in more precise ways. Now, even corporate governance, if we want to focus even more on corporate, is not new. The legal troubles of Microsoft, for example, were not the first of their kind. Standard Oil was broken down maybe 100 IBM was a nightmare for 30 years, at least. AT&T was broken up. So governance is not a new concept either in the corporate world. Corporate governance refers to many, many different things. It can be management, it can be shareholders, employees, regulators, whatever. The management is entrusted with the shareholders' trust. This means that the terminology is they are their agents. This means that they have to behave in a certain way. But if you leave people with billions of dollars at their disposal, millions of dollars at their disposal to behave in a certain way, they may behave in a different way. It's the same thing that happens with insurance. The moment you have insurance, the behavior of people starts to change. So you need to make sure that governance defines the guidelines and puts limits so that everybody knows what's expected of them, and everybody is rewarded or punished when they do or don't do the right thing. Now, governance has been a byword used to illustrate differences in opinions, and I would say in ideologies. So the Chicago school used to say laissez-faire, just let people do what they want and the market will decide. The Europeans in particular used to say, no, we will regulate to death. This is only one aspect of governance. It's important that shareholders monitor their company. In the United States today, shareholders do not monitor their company. Very low attendance at general assemblies. In the United States, they're not allowed to monitor their companies in the US either, because they cannot even remove a chief executive. There was a recent fight at Disney, they were not able to remove the chairman, even though only 40% voted for him to be removed. They removed him, as chairman, but they were not able to remove him as chief. The employees have a role to play also. Enron fell in part because there was a whistleblower. Somebody went and said that there's something completely wrong with the accounting system. Insurance companies have specific issues of governance. In addition to the normal issues of governance, they take cash from the public. Now, this morning there was a difference between regulation of banks and regulations of insurance that was highlighted. Systemic risk versus other types of risk. I think that if you think about it in terms of taking money and promising to return it in certain cases, banks take money from everybody and promise to return it when you want it. You just go to the teller of a bank and says, I want my money, they give it to you. Insurance is the same thing to a certain extent, but they promise to return it if there is a claim. So in that sense, in the meantime, they have to manage this money for you. They're fundamentally subject to the same class of risks. This is why, because they take the money from the public, they need to be regulated very thoroughly, just the way banks will be. And I will talk very briefly about the new law, because it's still a project in Lebanon. All modern laws in the insurance sector go that way. Make sure that they have enough capital for what they promise. Make sure that they're not overselling. Make sure that premiums are well accounted for, technical provisions, etc. Lebanon and the region are facing these issues today, and many of the questions focus on that. The Lebanese highlights. There's a definition in the new law about the Insurance Control Commission to be called, I think, Insurance Commission now. The qualification and capital adequacy ratios, Basel II being one class of these, clarifies scope of work of insurance companies, brokers, and agents. I've seen insurance professionals who did not know what could a broker do and what could not a broker do. Define methodology to account for technical provisions, and here actuaries will have an increasingly important role to play. And mergers and acquisitions, how to promote them the right. I would say that all of these measures combined will increase the fixed cost of an insurance company. They will increase the fixed cost, they will increase the complexity of managing an insurance company. And while you increase the fixed cost and at the same time you put some pressure on prices because of increased competition and transparency, what you have to do is merge in order to make the average insurance company larger to realize these economies of scale. It's the same thing in banks. Banks could be very small in Lebanon or elsewhere while they were manually managed on paper. But the moment you have to spend millions of dollars at least on your IT, hundreds of thousands of dollars on your senior executives, etc., you start entering into a zone where you cannot be profitable unless you're of a certain size. So I expect insurance companies, the average insurance company size to grow. Due diligence is often an essential part of transaction design. Its most delicate and critical point is how to handle values. I've put on the bottom of the page the two sentences from Reagan's speech. It's still play but cut the cards, we're still in business, or don't be afraid to see what you see. This makes the due diligence process all the more important and